Yes. The answer is yes. Of course, there's risk in managing our pensions, but risk is nuanced. And there's an argument to say that if we all increased our understanding of risk by a small amount, we could improve our retirement chances by a large amount. So, in this video, I'm going to talk about some simple aspects of risks that most of you will know, but some of you may not have heard. Now, in the world of risk management, which was my profession before I retired recently, we often talked about upside risk. Now, roughly in English, if we translate this, it becomes the chances that things will be better than we expected. So, what we're talking about really is opportunity. And I always think that risk and opportunity are two sides of the same coin, really. And if you consider one way or the other, you can actually run into some problems. Now, as human beings, we are programmed to fear more about losing than we are motivated about gaining things. So, this has been proved in many different social experiments and is the reason that if you actually asked a novice to look after a portfolio of pension investments, they'd start to lose it pretty quickly, really. And I think this is one of the reasons for this is that our instinct when an investment starts to drop in value is that what we'll do is we'll cash it in before we lose even more. But then again, our instinct when investments go up in value is to actually cash the gains in before they drop again. Now, both these things can actually be damaging to pension portfolios. Now, as chimpanzees don't really understand in investing, then if you give the same portfolio to a novice human investor and a chimp, where the chimp can only make random investments, then the chimp will pretty much always do better. Now, of course, professional investors go through advanced training in risk management relating to investments. And in general, they are trained to ignore these kind of natural instincts that cause this kind of risk aversion and the losses that come from it. But the problem with getting a professional to manage your portfolio is that they insist on being paid. Now, as they will only be slightly better than you in their investments, then by the time you've paid them, you'd have been better off, frankly, sticking with the chimp. So, what can we do? As you know, most of us generally don't have ready access to a chimp. So, the term to remember is index and chill. So, let's break that down. Uh, An index in investment terms refers to shares of a large group of companies all kind of bundled together. So that if some of them companies do well and others perform really badly or go out of business, then on average, you're not going to lose your shirt. The risk is spread amongst the companies. So we've started to diversify our investments. So index and chill. Spread your risk with an index fund and then chill out. Now, don't keep chopping and changing it is the advice. Even better, don't even look at it at all. One of my subscribers on here said that what he does is he checks his pension portfolio once a year on New Year's Day. And the rest of the time, he doesn't worry about it. And I think that's generally some good advice. Now, in investing, time is a very good leveler. You won't have missed the news recently about Trump's tariffs causing wide swings in the markets. And you can think of markets and indexes or indices interchangeably for the purpose of what we're discussing here. So if you looked at the stock index week by week over the last few months, even the indexes that we're talking about here would have gone up and down 5% or more each week. Now, given the advice of my subscriber about checking it once per year, then volatility of them shares that he will see will decrease significantly over a year. Even better, how about looking at the performance of indices over a 20-year period? And things will smooth out even more. Now, 20 years is my favorite time frame for looking at stock indices. And this is how I try and use them. Now, I have a pension pot containing all the money I've ever paid into my pensions over my lifetime, but I don't look at it as a single pot. What I do is I break it down into three buckets. Now, the first bucket is the money I need in the next 10 years. Now, I don't invest this generally in stock indices because I know these can go up and down quite a bit. So what I do, I invest this first bucket of cash in things that are much less risky. And I'll show you in a minute what I mean by this. Now, the next bucket I have is the money that I expect to spend between 10 and 20 years' time. Now, this bucket is a bit of a mix of very safe investments and some of the index investments that we're talking about now. So the final bucket of money is the money I will spend in 20 years' time. Now, at the moment, I'm 56, so this is the money I will spend from 76 onwards. And I'm confident that the indexes that I've invested in will perform well over that 20-year period. Now, it's important to remember that I'm not a financial advisor, and this is not meant to be financial advice. It's just information about what I've done with my investments and what I'm happy to do in terms of risk. So let's take a look at the numbers around this third bucket. And to do this, I'm going to look at the average return of these investments over the previous 20 years. Now, the index I've chosen to have a look at is a group of over 5,000 companies, all in one big bucket from all over the world. And I can buy single investments that splits my money over all these companies. So if I'd invested in this index, which is the All World Index 20 years ago, I would have had, on average, a return of 8.8% per year. Now, we all know that that large world events impact markets. And if we consider four of the biggest events over the past 100 years, namely the Great Depression in the late 20s, World War II, 39 to 45, the global financial crisis of 2008, and the global pandemic, of course, of 2020, then two of these cataclysmic events have actually happened in the last 20 years. And the world index has still returned nearly 9% average year on year during that 20-year period. So for the money that I don't plan to use for the next 20 years or more, then I personally like the world index. Now, other people have a different risk appetite than me, and they may choose a more volatile index for this kind of pot. One of these is a large American index called the S&P 500. And the argument goes that America is different, that America is exceptional. Now, this, what we call American exceptionalism, is largely based on the fact that America holds the world currency reserves, and this gives it more power, leading to better performance of the companies that are based there. So let's have a look at the S&P 500 and how that's performed over the last 20 years. So the average annual return of the S&P 500 over the last 20 years has been 10.9%, which is fantastic. Now, whether you believe America can keep that up for the next 20 years may indicate if you believe in American exceptionalism or not. Now, let's consider some other options. How about the FTSE 100, a group of 100 of the largest companies listed on the UK stock market? Well, that includes companies such as Unilever and Shell and HSBC. Well, these have done less well. The average return of 20 years has been 5.5%, and still not bad. How about we go for something with even lower risk, much less low risk? So if you have a self-invested personal pension, then you could choose an investment that actually doesn't track companies, but tracks the rate at which banks lend money to each other overnight. This is an investment called a Sterling Overnight Tracker, or a SONIA tracker. I use this for bucket one of my investments. That's the money I'll be spending in the next 10 years. And this pays a very steady 0.1% each week. It's actually linked to interest rates. And this, as we know, doesn't vary a huge amount. And that gives me a yearly return at the moment of about 5%. We can't, of course, put our pension into a bank account or stick under our mattress. But let's imagine we could. Let's assume the bank pays us 3%. And then there's the option to keep money under your mattress. Now, this last option for me is the highest risk option. Not because of burglars, but because of another pesky thief, inflation. So yearly average inflation over the past 20 years has been 2.8%. Now, the returns I've been discussing so far have been nominal returns, and these don't take account of inflation. But inflation's real. It happens to us all. So we should consider it, particularly when we're looking at investment returns over longer periods. So if we take off inflation, our new returns look like this. Now let's imagine I invested £100,000 20 years ago. How would I have done? Well, the mattress option, I'd have lost £43,400 from the value of my £100,000 investment. That's 43%. Now you can see why I say this is the riskiest option. Now, the bank option is not so bad. It'll give us a 4,000 profits over 20 years. The sterling overnight tracker is much better. That would have given me 55,300 over the period. Even though the FTSE hasn't done brilliantly over the last 20 years, it would still have given me a return of £71,600. Now, my choice has been the World Index, which has returned £232,000, while the US has returned a whopping £322,000.
With so many options, why choose Arizona State University?
For me, the only online option was ASU because of the quality. Their faculty was really involved with their students and care about your personal journey. The dedication to my personal development from my professors, that's been extremely valuable to me.
Earn your degree from the nation's most innovative university. Online. That's a degree better. Explore more than 350 plus undergraduate, graduate, and certificate programs at asuonline.asu.edu.
You just realized your business needed to hire someone yesterday. How can you find amazing candidates fast? Easy. Just use Indeed. Stop struggling to get your job post seen on other job sites. With Indeed sponsored jobs, your post jumps to the top of the page for your relevant candidates, so you can reach the people you want faster. According to Indeed data, sponsored jobs posted directly on Indeed have 45% more applications than non-sponsored jobs. Don't wait any longer. Speed up your hiring right now with Indeed. And listeners of this show will get a $75 sponsored job credit to get your jobs more visibility at Indeed.com/PODKATZ13. Just go to Indeed.com/PODKATZ13 right now and support our show by saying you heard about Indeed on this podcast. Terms and conditions apply. Hiring? Indeed is all you need.